On March 10, 2023, startup founders woke up to discover they couldn't access their money. Not because of a technical glitch. Not because of fraud, because their bank had collapsed overnight. We're talking about Silicon Valley Bank, an institution that had survived for 40 years, managed over $200 billion in assets, and was considered so safe that thousands of founders kept millions above insured limits there. The question isn't why the bank failed. It's why so many intelligent people made the same catastrophic decision to put all their eggs in one basket. Your brain has a dangerous shortcut. It's called the availability heuristic, and right now, it's probably influencing a financial decision you're about to make. Here's how it works. When you try to assess risk, your brain doesn't calculate actual probabilities. Instead, it asks a simpler question. How easily can I remember this happening? The easier something is to recall, the more likely you think it is to occur. Psychologists Daniel Kahneman and Amos Tversky identified this pattern in the 1970s. They discovered that people consistently overestimate the likelihood of dramatic, memorable events, while underestimating mundane but common risks. Ask someone whether they're more likely to die in a car crash or a plane crash. Most people say plane crash. They're wrong by a factor of about 50. But plane crashes make headlines. They're vivid, emotional, easy to remember. Car crashes are so common they barely register. Your brain mistakes memorability for probability. Now apply this to money. Imagine you're choosing where to keep your business funds. You have $200,000. You could spread it across multiple banks, staying under the FDIC insurance limit of $250,000 per institution. Or you could keep it all in one place. Easier, cleaner, less paperwork. What feels riskier? The hassle of managing multiple accounts, or the chance your bank could fail? If you haven't experienced a bank failure recently, your brain whispers, "Banks don't fail." That hassle feels more real than that risk. This is the availability heuristic at work. The inconvenience is right in front of you. The bank failure is abstract, distant, hard to imagine. So you take the risk without realizing you're taking a risk at all. By early 2023, American startup founders had forgotten something crucial. Not because they were stupid, but because their memories had been quietly rewritten by 15 years of stability. Silicon Valley Bank wasn't some fly-by-night operation. It was founded in 1983 specifically to serve tech startups. For 4 decades, it became the financial backbone of innovation. By 2023, SVB held accounts for nearly half of all venture-backed startups in America. Y Combinator companies. Famous unicorns. Founders who'd raised tens of millions kept it all at SVB. Why? Because everyone else did. But here's the critical detail. Between 2008 and 2023, not a single significant American bank had failed. The financial crisis felt like ancient history. An entire generation of entrepreneurs had built companies without ever experiencing a bank collapse. Greg Becker, SVB's CEO, had run the bank since 2011. 12 years without a crisis. The bank's deposits grew from $62 billion in 2020 to nearly $200 billion by 2022. Founders were depositing $5 million, $10 million, $20 million into single accounts, far above the FDIC insurance limit of $250,000. When advisors suggested diversification, many founders didn't see the point. The availability heuristic had done its work. The last bank failure was so far in the rearview mirror, it might as well have never happened. The risk felt theoretical. What felt real was the convenience of having everything in one place. The relationships. The specialized services SVB offered. Roku had $487 million at SVB. Roblox had $150 million. Streaming service Grindr had nearly half its cash there. These weren't reckless people. They were sophisticated companies with finance teams and auditors. But they'd all made the same mental shortcut. Then SVB made a classic banking mistake. They'd invested heavily in long-term bonds when interest rates were low. When the Federal Reserve raised rates aggressively in 2022 and 2023, those bonds lost value. On paper, SVB had a $17 billion hole. On March 8, 2023, SVB announced it needed to raise capital. Within 48 hours, depositors tried to withdraw $42 billion. The bank didn't have it. By March 10, regulators shut it down. It was the second largest bank failure in American history, and thousands of founders suddenly couldn't make payroll. The availability heuristic isn't just about what you remember. It's about what you've experienced recently. and recency has an outsized grip on human judgment. In 1973, Kahneman and Tversky published their foundational research on this bias. They asked people to estimate whether there were more English words that start with the letter K or more that have K as the third letter. Most people said words starting with K are more common. They're wrong. There are roughly 3 times as many words with K in the third position. But words starting with K are easier to recall, so people overestimate their frequency.
This same mechanism governs how we think about financial risk.
After the 2008 financial crisis, people were hyper-aware of bank fragility. Everyone diversified. Everyone was cautious.
But memory fades.
By 2020, a study by the Federal Reserve found that Americans' perception of bank risk had returned to pre-crisis levels.
15 years of stability had erased the lesson.
Behavioral economist Richard Thaler documented this pattern extensively. In his book, Misbehaving, he shows how investors consistently make decisions based on recent performance, rather than long-term probability. When stocks have been rising for years, people perceive them as safe. When they've been falling, people perceive them as risky. The actual fundamentals barely matter. What matters is the story your recent memory tells. Here's the mechanism. Your brain uses availability as a proxy for frequency. If bank failures don't come to mind easily, your brain concludes they must be rare. And if they're rare, they won't happen to you. This is why people buy flood insurance right after a flood and cancel it 5 years later. The risk hasn't changed. The memory has. For SVB depositors, the math was invisible. They weren't consciously thinking, banks never fail. They simply never thought about bank failure at all. The risk didn't exist in their mental model. When Etsy's CFO was asked why the company had over $100 million at SVB, he said it was considered conservative and safe.
Not because of due diligence,
because of reputation. Because everyone else was doing it. The availability heuristic had created a collective blind spot. What was easily available in their memory? SVB's 40-year track record. Y Combinator's endorsement. Their competitor also banking there. What wasn't available? Washington Mutual's collapse. IndyMac's failure. The fact that banking crises follow predictable patterns. Those memories had faded. And so had the caution they once inspired. Not everyone missed the warning signs. A small group of investors and analysts had been sounding alarms for months. What made them different? They deliberately counteracted the availability heuristic.
In late 2022, a handful of hedge funds began shorting SVB stock.
They'd noticed something. The bank had an unusually high concentration of uninsured deposits. Over 90% of deposits exceeded FDIC limits. And SVB's bond portfolio was underwater due to rising interest rates. These investors weren't smarter than startup founders. They'd just trained themselves to look at base rates rather than recent memory. Base rates are the actual statistical frequency of events, independent of your personal experience. What's the historical failure rate of banks during interest rate spikes? What percentage of deposits above insurance limits get recovered in a bank collapse? These questions don't rely on memory. They rely on data. Bill Ackman, the hedge fund manager, later explained that the SVB collapse was entirely predictable to anyone studying bank balance sheets. But most depositors weren't studying balance sheets. They were relying on the heuristic. It's been fine, so it will be fine. Morgan Housel makes this point beautifully in The Psychology of Money. He writes that we tend to judge financial decisions by their outcomes, rather than by the quality of the decision at the time it was made. Keeping $10 million in a single bank looks smart when nothing goes wrong. It looks catastrophically stupid when the bank fails. But the decision was always risky. The outcome just made the risk visible.
Consider the founders who did diversify. They weren't psychic. They'd simply asked a different question. Instead of, "Has my bank ever failed?" quote, they asked, "What happens if my bank fails?" That cognitive shift changes everything. One founder of a Series B startup kept exactly $249,000 at SVB and spread the rest across 3 other banks. Extra paperwork? Yes. But when SVB collapsed, he made payroll on time while his competitors scrambled. The difference wasn't intelligence. It was which mental model he used. He'd forced himself to consider the base rate of bank failures throughout history, rather than relying on his recent experience. Interestingly, older founders were slightly more likely to have diversified. Why? Because some of them remembered the savings and loan crisis of the 1980s and 1990s. That memory was available to them. They'd lived through bank failures. The availability heuristic actually protected them because they had a different set of experiences to draw from. This reveals something crucial. The heuristic isn't always wrong. Sometimes recent memory accurately reflects current risk. The problem is, you can't tell the difference from inside your own head. So how do you make better decisions when your brain is constantly lying to you about probability? The answer isn't to fight the availability heuristic. That's exhausting and usually fails. The answer is to systematically feed your brain better information. First, create a pre-mortem before making any significant financial decision. Spend 10 minutes imagining it's gone catastrophically wrong. Write down exactly how it failed. This sounds morbid, but it's remarkably effective. Psychologist Gary Klein found that pre-mortems increase people's ability to identify risks by 30%. Why? Because you're forcing your brain to make the failure scenario available. You're manufacturing a memory of something that hasn't happened yet. For the SVB depositors, a pre-mortem would have asked, what happens if this bank fails tomorrow? Can I make payroll from other sources? How long until FDIC insurance pays out? Do I have 90 days of operating expenses accessible elsewhere? These aren't fun questions, but they're the antidote to the availability heuristic. Second, study base rates obsessively. When you're tempted to think, that won't happen to me, look up how often it happens to people like you. Historical bank failure rates, average losses in market corrections, percentage of startups that face cash flow crises. The numbers are freely available. Your brain just prefers stories to statistics. Since 1934, the FDIC has handled over 500 bank failures. That's an average of about 6 per year. Most happened in clusters during crises, which means long periods of calm followed by sudden chaos. If you'd known that pattern, would you have kept $10 million uninsured? Probably not. Third, diversify by default, not by decision. The smartest depositors didn't rely on willpower. They created automatic systems. Some founders set up a rule: no more than FDIC limits in any single institution, no exceptions. Others kept operating expenses in one bank and reserve funds in another. The key is removing the decision from your moment-to-moment judgment. Your brain's availability heuristic is strong during good times. You need a system that works even when everything feels safe. Remember that opening question? Why did so many smart people make the same mistake? Because they were using the wrong question. They asked, has my bank been safe? The right question was, what's my plan if it isn't? The availability heuristic will never go away. Your brain is wired to use recent, vivid memories as a shortcut. But you can choose which memories to make available. You can deliberately expose yourself to historical failures, statistical realities, and worst-case scenarios. Not to become paranoid, but to become calibrated. The founders who survived the SVB collapse didn't have better luck. They had better questions. And in the gap between those two things sits every fortune that's ever been lost, because someone confused a calm past with a safe future. If you found this valuable, you'll want to watch our breakdown of mental accounting and why winning the lottery makes you poorer. It's the same psychological trap, different context. Subscribe so you don't miss it.